Hey everybody, welcome back to the channel. My name is Justin, and in this video, I'm going to go over my top 3 stocks to buy for November 2023. I think all 3 of these stocks have a margin of safety, and I think all 3 of these stocks are a hedge against inflation and elevated interest rates, because I personally think they're going to be elevated through the end of next year. So let's just get right into this first stock. All right, stock number 1 is Great Lakes Dredge and Dock, ticker symbol GLDD. This stock is near its 5-year low on stock price, trading just above $6 here today. This is a micro cap stock, so it's under a $500 million market cap, so it is a very small company. Now, as far as a business overview for this company, they are in the dredging space. So they own these massive ships that go into the ocean and they clear waterways so that ships can move through them. You could think of a huge hose going from the ocean all the way to the land, and they're moving sand to be able to allow boats to go through. So they do have different parts of their business that generate revenue. In fact, they have about 3 to 4 different pieces of their business. So one side, which is their biggest, is their capital side, which is about 53% of the revenue. That's where they do port deepening, expansion, coastal restoration, and much more. They have high margins with their capital side of their business. They also have coastal protection, which is about 30% of the revenue. That's where they create and rebuild beaches. And then they have their maintenance side, which is their lowest margins, which is about 15% of the revenue, where they maintain depths of waterways and harbors. Something that's important to note is that earlier this year, there was a record funding by the U.S. Army Corps of Engineers, totaling around $8.6 billion that got approved from the business, and about $2.3 billion provides funding for the maintenance and modernization of waterways, which should go to dredging companies like Great Lakes. The company has been dealing with a lot of different headwinds over the last 18 months. In fact, this year, they should only hit around $600 million of revenue, which is their lowest amount of revenue in the last several years. But going into the future, it does look very promising, which we'll talk about more in a second. So their backlog over the last 5 years have averaged around $557 million. Earlier this year, it was all the way down to $370 million, which is one of the lowest points in the last several years. However, as of this last quarter, it doesn't show it in here. This is a snapshot as of June 30th. But as of September 30th, they have over $1 billion in backlog, which is absolutely tremendous. They brought in over $500 million of awards that they won in the last quarter alone that were tied to capital projects, which have the highest margins. So like I said earlier, the company looks to be in really good position going into 2024. I don't always look at book value per share as a valuation. Sometimes it makes sense when you're looking at banks, but it is kind of interesting looking at Great Lakes. Now, when I look at them specifically and trying to figure out a valuation, I look at next year, they should be around $800 million of revenue or even more based on their backlog. If they can do that, they should be able to generate between 70 cents of EPS to $1 of EPS. If they can do that, historically their PE has been around a 17, so the stock price should be around $12 to $17 by the end of next year. The big key to that, as long as they can continue to keep their backlog up, somewhere around 600 to 700 million or more. Next company on this list is Raytheon Technologies, ticker symbol RTX. They're currently trading just above $80. They were up over $100 for most of this year. Their Pratt & Whitney division had some issues a couple of months ago where they had to impair about $2.9 billion worth on the P&L, which scared investors, and their stock is down and has been down over the last couple of months. But I think this is a really good buying opportunity to buy into a great company. So RTX is separated into 3 different segments. So they have their Collins Aerospace division, Pratt & Whitney division, and their Raytheon division. Keep in mind that Raytheon and United Technologies merged in 2020 to make RTX here today. What's even more interesting is that Collins Aerospace, Pratt & Whitney, and Raytheon, all 3 of their business segments, do roughly amount the same of revenue each year. So they're almost a third of the business. What's also unique about RTX versus a lot of other government contractors is they have more diverse revenue streams. So their Pratt & Whitney division, for example, which produces around $30 billion of revenue, is more on the commercial side for Boeing and Airbus because they make the engines for those planes. But RTX also has a lot of defense contracts. So I do like that mix versus their competitors. So there are some really interesting things that were announced in this last earnings call just a couple weeks ago. The company announced that they are accelerating their buyback program, and they just approved $10 billion of share repurchase. They also increased their post-merger capital return commitment to $36 to $37 billion to shareholders through 2025. That is up from $33 to $35 billion. So I think that is a good indication management feels comfortable that their free cash flow, which they have projected to be about $9 billion in just a couple years at the end of 2025, they are heading towards that goal, and they're able to give more back to the shareholders in the short term. Like I said earlier, they have a really good mix of different revenue streams in their business, and currently they have $190 billion of backlog. This is a company that should produce around $70 billion of revenue on the top line. So they have almost 3 years worth of revenue, which is absolutely impressive. About $75 billion of that is on the defense side for government contracts, and then the rest is on the commercial side. So this is how I see the valuation for RTX. This is a discounted operating earnings model. I think that sales is around 9% per year over the next several years. I think operating margins are going to normalize or stabilize around 12%. So their operating earnings should grow around 11% per year. The market multiple on average over the last few years has been a 23, which is pretty consistent with other government contractors, so that is not out of the norm. So based on the information, I come with an intrinsic share price of about $95 here today. The stock price is trading around $80, so it's not a huge margin of safety, but I do think it is a great company at a decent price right now, and it should be kind of a low risk type of stock. The third and final stock I want to talk about is Tyson Foods, ticker symbol TSN. This is a stock that is down roughly 25% over the past year, going from about $70 all the way to about $45 here today. Tyson Foods is a very well-known brand. In fact, they have some of the most popular names out there, which we will talk about their iconic brands here in a second. But they primarily produce beef, pork, and chicken. In fact, for every 5 pounds of meat that's sold in the United States, 1 pound comes from Tyson Foods. So that is roughly 20% of the total market. They also sell their product in about 140 different countries. They also have over 11,000 independent farms that supply them with cattle, hogs, and chicken. Some of their most popular brands you will automatically recognize, from Hillshire Farm to Jimmy Dean to Tyson, Ballpark, State Fair, and much more. It is extremely difficult, in my opinion, to have a competitive advantage when it comes to the food space in general, but Tyson Foods is very unique and does have a competitive advantage in their space. And you can see the market share that they take within different segments of their business. So for example, they're number 1 in frozen prepared chicken, number 1 in frozen protein breakfast, number 2 in lunch meat, number 1 in breakfast sausage, number 1 in hot dogs, number 1 in smoked sausage, stacked bacon, corn dogs, and super premium smoked sausage, and number 2 in adult snacking combos. To support they have a competitive advantage even further, this slide shows that, for example, frozen nuggets, they own 42% of that space, where their nearest competitor is at 8%. Frozen strips, Tyson owns 37% of that space, while their next competitor in line is 7%. So you can see they own a significant part of different food segments across the board. Now, I do want to point out that Tyson Food, the stock price has dropped quite a bit over the past year because of challenges and headwinds that they have been encountering over the last year or more, and particularly on the pork side of their business. So they recently came out and updated their guidance for 2023, which also created their stock price to drop even further. So originally they thought sales would be around 53 billion. Now they think it's going to be around $40 billion. A lot of their margins for their chicken, beef, and pork are going to be flat or even negative. So pork margins, for example, are going to be between -2 and -4% for this year. And they've been dealing with a lot of different supply chain issues from transportation and also manufacturing. But it should get better going into the future in 2024 and even into 2025. But I do expect to have a lot of fluctuations and headwinds on the supply chain management of the business over the next 12 months. Now, as far as a valuation for Tyson Foods, I think they're going to grow their sales around 3 to 4% per year over the next several years. I think operating margins are going to be around 7.5%. So I think operating earnings is only going to grow about 1% per year over the next several years. Based on a market multiple of 11, that gives me an intrinsic share price of roughly $73. So I do think that the stock price trading around $46 here today, it does look like it's at a very, very good value at this time. They also pay a really solid dividend, and their balance sheet is very, very good. They have very low debt. So with these high interest rates that we're seeing, and I think they're going to be elevated for a while, that should not hurt Tyson Foods business because they are not highly leveraged like some other food companies that are out there. So those are my 3 stocks that I'm buying for November 2023. So again, that's Great Lakes Dredge, that's RTX, and that's also Tyson Foods. But I would love to hear from you guys in the comment section. What do you think about these 3 stocks? What are you buying for November 2023? Drop down a comment below. If you haven't already, go ahead and like that video. If you like this kind of content, encourage you to subscribe to the channel. Thanks for watching. Catch you on the other side. Take care, and God bless.